Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
Factor ETFs fail to deliver on their promised outsized return. So this is I thought this would be a good educational moment on investing. Okay, so we are big on academic research here at the Investor Coaching Show. The idea behind factors, let me just explain. You've got different factors of investing. Eugene Fama, Nobel Prize 2013, came up with this idea of factor-based investing. And he said, there are three factors that drive 95% of returns. We got large companies versus small companies. First one was really stocks versus bonds. How much do you have in stocks versus how much do you have in bonds? And that's very time horizon driven. So if we're looking at stocks versus bonds, as we get older, typically what we do is we start to add bonds to an investment portfolio, because if stock markets go down, I don't want to sell stocks when the market's low to get income. I want to have some fixed income that I can draw income from to allow time to wait for the stock market to come back. And then, so that's that deal. Now, if I have a certain goal in mind, I'm going to put a kid through college in 7 years. I might put, let's say, 75% of the money in stocks, knowing that historically, I don't have a 7-year period, 8-year period somewhere in that neighborhood where I haven't made a return in that type of an asset mix. So, hence that is why that is the first thing you look at is time horizon, because how much income am I going to take from the portfolio? If I'm taking a higher percentage out of the portfolio, I might not have as much in equities. I may, if I'm taking a lower income, or let's say I'm younger and I'm more concerned about inflation and the devaluation of the dollar, I might have more equities, because historically stocks protect against inflation, whereas fixed income bonds have not. So, this idea of factor investing is pretty well established in investing circles. The problem is, Ira, have you ever heard how many different factors there are out there, investing factors that are to choose from that are actually researched?
Well, we're just 5.
Yeah, but you know how many there are?
No.
400.
400.
It's ridiculous. Yes. I mean, it has become a way of gambling with people's investment portfolios. So just because somebody says that they're factor investing, don't necessarily look at it and go, oh, this is good.
No, I think most people, when they hear that, they're like, you know what? I'm sure I can't understand it, so I'll just go with it.
That's true, probably. I get it.
As long as you understand it, Paul.
Yeah, yeah.
Well,
and this is, what we look at are the factors that actually matter.
Well, what we're looking at are actually the factors that have premiums.
Right, exactly.
To investing.
So if we look at, for example, large companies versus small companies, we see that there has historically been a premium 83% of 20-year periods. Small companies have had a higher return than large companies. Now, just remember, 83% of 20-year periods, which means, by definition, 17% have not. Yes, thank you. Yes, exactly. So it's not a guarantee. So I'll come back to that. Then you've got value versus growth. Value stocks have outperformed growth stocks 95, 96% of 20-year periods. Value has done better, which means that 5% of the time, growth stocks have done better than value in 5-year periods. Now, if we look at shorter periods of time, 10 years perhaps, you're going to see it is more... It's closer to half and half, and depending on the asset category, but you won't have as dominant an outperformance of the factor in a shorter period of time. You won't have where it does it so much, or that it's such a high percentage of the time that the factor, the higher expected returning area, like small versus large or value versus growth, that you'll have that outperformance. So hence, that is the reason I object immediately to the headline of this article. Factor ETFs. Now, it doesn't say what factors. It does in the article, and some of the factors are not ones that you would use. Like, you would use momentum, and you do use that in the article, but you don't use it as a way of increasing return. The research doesn't bear out that you use that as a way of increasing return. You use it to reduce expenses. And I won't get into that because it's too nerdy. Then you get into, other factors that might be utilized in the investing process, which would be like, for example, well, they talk about the minimum volatility factor, which is horse fetish. It's one of the 400, Ira. It's one of the 400 factors that are out there that are not useful. But you probably have seen them before. There are minimum volatility funds out there. And I've talked about it. I hadn't seen, because they hadn't been out there when I talked about it here on the radio show. They hadn't been out there long enough for me to really tell you much about it, other than to say probably the returns aren't going to be anything to brag about, because if you reduce volatility, then you actually get rid of return too, because risk and return have always been related. Well, the verdict is in. The returns have been basically the same as bonds, if not a little bit less. So it did work out the way I would have expected. Then you have the quality factor, which is not a factor that you would use. Now, you would use a profitability factor. A profitability factor can be used to help make sure that the asset class is more pure for value. But, again, too nerdy for this. But here's the point. Is number one, if you read that headline again, it says the factor ETFs failed to deliver their promised outsized returns. Over what period of time? 10 years. Which is ridiculous. 10 years is goofy. You may say, well, that's a long period of time, isn't it? No, it's not. It says, although the theory is that these factors will generate superior performance over the long run, not one of the factor ETF groupings did so over the past decade. Well, that's misleading. That's misleading, too, because, well, Nick, this is actually you and I were talking about before this on the show, before the show started. Yeah. Probably a good time to talk about it, huh?
Let's do it.
Okay. So Nick was, he's just asking about 401k. And I said, well, one of the things that I want you to do is what we do for our clients is bring in the 401k choices that you have. And I'll take a look at what's going on. And he goes, oh, yeah. I said, how do I do that? And he and I were talking about his. And we went online and looked at all the choices. Well, all of the money that he had in his 401k was in a Target 2050 fund, wasn't it? I think it was 2060 fund.
Yeah, 2060.
A Target 2060 fund. So if you're retiring the year 2060, you put all your money in this particular fund. It was a Vanguard fund. And he laughed at it, as like, I didn't know it was there. And I said, yeah, a lot of times what'll happen, that will be the default. They'll just stick it all in that. It's funny because he's been producing here in the studio, in the Goodlettsville studio, this show for, what, a year?
About a year, yeah.
And, I've talked a lot about that, but he didn't even realize it, which is, you think about that. How often do we not even pay any attention to what we're investing in our 401ks? We just, so often, we'll just say, what did they put me in? They put me in, well, they must have put me in whatever was the best thing for me. And quite often you will find that is the case. The employer will default to that particular type of plan. And I've never been a fan of those things, because what they do in those particular types of plans is they focus on, like the Vanguard 2060 fund, they're going to put most of the money in two funds, which is the total U.S. stock fund, and then the total international stock fund. And those two funds are capitalization weighted. They're weighted more to the bigger companies. So you will find that companies like Apple and Microsoft and Amazon and these huge companies, that's where most of your money is in these funds. You're not really well diversified in them because they're weighting based on that. So if we look at that and say, okay, so what's wrong with that? Well, the problem with that is that where do we expect lower returns? Large companies, which is what we're talking about right here, and growth companies. We're in those two areas. And in this particular article, they're saying the factors have failed to deliver promised outsized returns in the past 10 years, which is not the whole story. What happens is your numbers can be skewed based on the time period that you select. During the Trump years, the returns were so high for that particular area of the market, large growth, which is ironic because a lot of those companies would represent companies that weren't necessarily friendly to Trump. like social media companies and technology companies and the huge companies. And it is ironic that was the case, but it just so happened to be the case that when he was president, those companies dominated. Now, those companies, mind you, also dominated in the late 90s and throughout the 90s. And throughout the year, from the year 2000 through 2010, actually had negative returns. So you can go and go, wow, you know what? The factors didn't show up from 1990 through 1999. So if you looked at those factors during that period of time, from 1990 to 1999, S&P 500 had a rate of return that was 2% higher per year than large value stocks did, and 2% higher per year. Now, that may not seem like a lot, but it's a pretty big deal when you look at that over time. It was 2% higher than large or small value stocks were over that same period of time. Okay? So if you look at that and go, wow, okay, so in that particular instance, you literally had about a 25% difference in accumulation over that 10-year period if you look at the S&P 500. Now, over the next 10-year period, however, the S&P 500 lost 1% per year. So let's say you had $100,000, it shrunk to $91,000. Versus with large value stocks, it went up by 33%. With small value stocks, it would have gone up by 174%. So if you look at that and you said, hey, wow, you know what? The factors didn't work in that 10-year period. They had a 2% lower return per year. I'm saying, so? So, it didn't work. And you go, well, what are you going to do? I'm not going to invest in that anymore. Yeah, there you go. Kiss 174% growth goodbye, and become very well acquainted with a negative 9% return over that same period of time. And then that's using the period of time from 1990 through 1999, and then 2000 through 2009. And I'm using Fama French Large Value Research Index, Fama French Small Value Research Index, just for the record. So these, if you look at and it's not a regular index, by the way. So don't look at that and say, oh, I just buy an index fund. No, those research indexes are very, very different. They're very well engineered. But anyway, if you look at that and go, man, that was probably, and then what he does in the article is he looks at correlations. And he says, the correlations were high during that period of time. Well, correlations between stock asset categories are always high. Mm-hmm. If you look at the period of time over the last 10 years, and he has correlations being above 80, 0.8. So in essence, that's a high correlation. If you have a 1 correlation, it means things that move always with each other. If one goes up, the other goes up. But here's the problem. Even during the previous period of time that I was talking about, from the year 1990 through 1999, remember, and from 2000 through 2009, the correlations were still that high. Okay, so why does that matter? They were that high, but remember, one went down 9% and the other one went up by, like what did I say, 180? Mm-hmm. Something like that? 174% return. 174% return. The correlations, if you look at that, don't tell you everything. Now, I talk a lot about correlation in investing, but mainly where I am focusing on correlation is stocks versus bonds. And that being, I want a little bit of a negative correlation if I can get it. That's what I'm shooting for. And that's where you actually see a slight negative correlation where they move opposite each other, because that is critical when you're physically in retirement. If stocks go down, I would like something that historically tends to go up or hold its value, like bonds, during that period of time. I don't want to be confusing. I know this is probably already confusing. But here is the point. This article is written by a person that's all they do is they focus on finance day in and day out. And you may read something like this and go, oh, this thing doesn't work anymore. Factor-based investing. And interestingly, when Nick and I had this conversation, we were talking about, he says, I've been investing in this particular fund for 3 years. And I said, oh, you were probably okay.
Yep.
I did, right?
Yep.
It's exactly what I said. I said, you were probably okay.
You
Then
said I
I'm like-
lucked out.
Then I said, you lucked out. Your luck is, yeah, exactly. I said, you lucked out because I thought during the past 3 years, large and growth did better. Boy, was I wrong. I went and actually looked at the numbers, and it was not the case. It was out of all the 12 different stock asset categories that you would hold, it was like number 7 or number 8, which is really interesting. I don't pay attention to every, so as you look at every single year, it'll drive you crazy. But it was surprising. So, in effect, what we're saying here, if you look at this person's saying 10 years it didn't work. It worked in the last 3 years.
Mm-hmm.
It was just that one little period of time that was so skewed that it made the 10-year period skewed, if you know what I'm saying. But if you looked at the last 3 years, if you had made this decision 7 years in, 3 years ago, and you said, well, the 7-year performance of the factors wasn't there, and then you bailed out, you would have messed yourself over, to be kind, over the past 3 years, pretty significantly too.
Well, that's the reason, Paul, I use the example of marriage and, issues that you have in marriage, disagreements that you have in marriage.
I never have disagreements.
Because you just say, yes, honey.
No. If my wife's listening, she's like, shut up. She's like, no. You're not
No,
going.
but the reality is that, a lot of people, they give up, because they have a few disagreements. And, when I talk to my clients, and it works really well in the workshops that we do, and we talk about, well, how long have you been married? And I'll say, raise your hands if you're married. Keep them up if you're married more than 10 years. Keep them up if you're married more than 20 years. Keep them up if you're married more than 30 years. And then, someone's up, keep them up if you're married more than 40 years. And there's usually a couple.
And then you got some people cheering.
Right.
Right?
Yeah. And then, so I'll just do the numbers of days that they're married and ask, did you have any disagreements? And, oh, yeah. And, so you could have ended at any time, or how long did you court? And, 2 years. Okay, 730 days. So, and I'll just step through the number of days and say, and I do preface it and say, now, I don't want you to start digging up the disagreements,
Knock down, drag out.
And then I say, how many children do you have? How many grandchildren do you have? How many memories do you have? Oh, my gosh, so many memories. More than disagreements? Oh, yeah, a lot more than disagreements. Why do they have more memories and disagreements? Because they stayed the course. They worked out the issues, which is what I love about what we do. When we say, look, our coaching really begins when the markets go down, because that's when you're going to actually put yourself in trouble. You're going to blow up your own portfolio. And that's where we talk more to our clients about what's really going on. 3 years, and I learned early on in my career, March will be 40 years, is that when I started in the business at 23, I looked at this and said, all right, well, retiring 65, that's a long-term career. And you're taught by these companies, well, long-term, 5 to 10 years. And so I would say...
You mean long-term, they're working for the company, or long-term is investing for that long?
Long-term investing.
Oh, okay, gotcha.
5 to 10 years.
5 to 10 years long-term, yeah.
And most are, I'm a long-term investor. And I'm thinking, all right, well, good, I'll have them for my whole career. And I found out fairly soon that long-term for me really meant something very different for clients. Long-term for me went, I'm going to have you for the rest of my life. Long-term for clients was until the market went down. Get me out.
Yeah.
It's like we talked about the time horizon on the portfolio being a 6 to 9 year or a 10 year for a market cycle based upon the mix of the portfolio and such. So investors, they can get caught up on all kinds of things. And the Dalbar study shows how poorly investors do compared to the market. And that's an updated study every year for a 30-year period. And it's because of the mistakes they make and the goofy things they chase. And, the thing about the target date portfolios that I dislike the most is that when you get to the periods, if you were to look at a target date portfolio now that's let's call it a 2015, that's overly weighted in fixed income.
Yes, that is absolutely true.
You know, when you compare that to the Trinity study, which shows that you should have, you know, if a successful portfolio with a 50-50, and I think the Trinity study is a little misguided as well.
Yeah, and that has been updated as well. So some of that, you know, the Bengen research, he's done a lot of really interesting things where he's tried different distribution rates. He's added value in more recent years. So I think they've gotten better in recent years.
Right, but the initial Trinity study, which has been the hallmark of the industry itself.
And then that was only a couple asset categories, right?
But they did have, even just with a couple of asset categories, a long-term approach, which was good. But it showed that with a 91% success ratio, you needed a minimum of 50% stock.
Mm-hmm.
And you get into those target date funds that are 2020, 2015, you know, they may have 40% stock in them. So you don't have enough equities, you don't have enough stock to outproduce inflation if you're taking a distribution. That has
been part of the problem that people have had, and you know, some of the criticism of those funds. And it's interesting because some of the more recent research shows that actually holding more in equities as time goes on has been a benefit. You know, when you actually increase the amount of equities, which goes against what we would commonly think in investing, that you would actually increase that as you got older. But you think about it, if you're older and you really have if you look at it, I'm not going to get into that. It would take too long to get into that. But, you know, in essence, what happens is just the research shows that, because it would be probably an hour-long conversation if I got into some of the research.
And we have commercials.
And we got commercials.